con este especial Reserva Federal, pero antes, tenemos una invitada especial hoy en Negocios Televisión. Es todo un placer poder entrevistar a una persona que gestiona tanto capital y que también ha dado pasos importantes en los últimos meses, sobre todo opiniones importantes de qué tenía que hacer la Reserva Federal, de a dónde iban los precios. Fue una de las primeras personas en hablar del entorno de desinflación, esa caída en los precios de los vehículos, que ya comentó varias veces Cathie Wood. Cathie Wood es fundadora, directora ejecutiva y CEO de ARK Invest. Welcome, Cathie Wood. Thank you very much for your time and for being here at Negocios Televisión.
Thank you, Javier. I'm very happy to be joining you.
We are happy to also, Cathie. Today, the Fed decided to raise 25 basis points again. There has been some debate among economists about the pace and magnitude of the rate increases. From your perspective, do you believe the Fed's actions are too aggressive? And how are these rates also increases going to impact the different sectors of the economy? What are your thoughts at ARK Invest?
Sure. Yes, we're on record as saying the Fed has been too aggressive, taking up interest rates now 22-fold. 22-fold in a little more than a year's time. This has never happened before. And I think that the bond market is saying that the Fed has been too aggressive. We've got the 10-year Treasury bond yield at 3.8%, and the yield curve is inverted at roughly 100 basis points, which we really haven't seen since the early 80s. But if you compare early 80s, 100 basis points on a 15% interest rate is much less significant than 100 basis points on a 3.8% long-term Treasury yield. So I think the Fed's much tougher. We think inflation is going to continue to unravel and move into deflation within the next year, and we do think we will have a harder landing. So what does that mean for the market? Interestingly, the market is beginning to look through this interest rate increase. And I think Chairman Powell just said monetary policy is restrictive because real rates are high, much higher than the neutral rate. So it probably means we're going to see some disappointments in terms of economic activity, but I think the bigger disappointments are going to be in profit margins, and especially at companies that are basically allowing these very large wage gains to go through 8, 9, 10% per year. I think that's going to hit margins more than it will filter into inflation because monetary policy is too restrictive.
Very interesting context, Cathie, with this with these margins going lower and these economic conditions. I think at ARK Funds you are very vocal about investing in growth stocks and also innovation. So yes. What do you think about these particular stocks for the near future? Are they going to take advantage of these dynamics?
Yes, what's interesting about growth stocks, particularly those focused on innovation, all of our companies are focused on disruptive innovation. And they are used to operating in a deflationary world. In fact, they're going to be one of the reasons that we see deflation because technologies follow learning curves, which are expressed in cost declines over time and cause significant unit growth. So I think what hurt growth stocks and especially innovation stocks in 2020 and 2021 and 2022 was first the fear of interest rates going up and then actually interest rates going up at a record rate. Now the market is beginning to look through this rate increase and is basically saying inflation is down, growth is going to disappoint. That means interest rates are going to come down within the next year. And that's very good for long duration assets like growth strategies, and especially for the longest duration growth asset equities in the innovation space.
The question I was going to ask, Cathie, about the duration effect, I think that's the key answer for this question. And talking also about this duration effect, we saw during 2023 the stocks that have low duration doing better than the stocks that have higher duration. Do you think this is going to change for the next weeks or next months? Because weeks could be a little time.
Yeah, I think the longer duration assets, which benefit from lower interest rates, are in contrast to shorter duration, which tend to be more cyclical and actually depend on pricing going up. So just to consider the companies that are UPS, the airlines putting through wage increases in the 8 to 10% per year range, that must mean they think they're going to be able to pass those wage gains through in terms of pricing, and we don't think they will. We think that consumer is already going on strike against pricing. And to give you an example of that, over the last few years, delivery costs of food have gone up dramatically, and now consumers are no longer going online as much as they are going to the stores to pick up the food or whatever goods they've ordered, because it's just too expensive. So the consumer has reached, at least in the United States, a limit. And if I think about the rest of the world, we believe that Europe is in recession. The German economy is leading the way down there. And one of the reasons for that is China. Europe is much more dependent on China than the US is from a trade point of view. And China is now exporting deflation. Their PPI was down 5.4% on a year-over-year basis. And we think that's going to get worse before it gets better.
Soon I will ask you about the CPI and the deflation scenario. But first of all, Cathie, can we talk also about Bitcoin? Because I want to know your current opinion in ARK Invest of the current price of Bitcoin, and also its future adoption through your ETF, for example, and also through your prediction until 2030.
Yes, so we are very positive on Bitcoin, and we got a very important signal in March of this year as regional banks in the United States started imploding, and some of them went bankrupt. As that was happening, Bitcoin went from 19,000 to 30,000. That was a flight to safety, interestingly. Many people think Bitcoin is risky, but in our view, it was a flight to safety. Bitcoin is a hedge against both inflation and deflation. We know that it's mathematically metered to top out at 21 million units. We're up to 19 million units. So it's developing some scarcity value right now, and certainly will protect if people think inflation's the risk. We don't think inflation is the risk. We think deflation. What happens when deflation happens? Well, then you move into counterparty risk, which you don't face on with Bitcoin. 0809, we saw the epitome of counterparty risk, where you couldn't trust financial institutions and companies to make good on their promises because they were over leveraged. That is not the case when it comes to Bitcoin. So that flight to safety, very interesting proof of concept in March. And yes, our forecast right now, Bitcoin is a little below $30,000. And our forecast for 2030 is, our base case is in the 600 to 650,000 range. Our bull case is closer to 1.5 million, and from 30,000, that would be quite a ride. One of the reasons we lowered our base case is because of what happened to FTX last year and the thought that institutions would not start moving into this new asset class, that they would hold back. That does not appear to be the case. It seems like institutions, we know BlackRock and Coinbase have struck a deal. We know that we're hopefully close to getting a Bitcoin ETF. And I think many people are understanding now that FTX actually proved the concept. FTX was very centralized and opaque, not transparent at all. And there was fraud there. Now, that couldn't happen with Bitcoin. It is very decentralized and completely transparent by IP address. You can trace what's going on online with IP addresses, and we have a full-time analyst focused on on-chain Bitcoin analytics. And so that transparency is one of the reasons that we also don't believe you could see an FTX happening within the Bitcoin ecosystem.
Very interesting, Cathie. Also talking about another key concept right now, it's the IA, the artificial intelligence, sorry. And right now, what is your main focus with that? Well, you have an ETF that it's focused on innovation and also growth. So I think it's quite good for ARK, right?
Oh, it's very good. So we know that NVIDIA has gotten a lot of publicity because of ChatGPT. It is the big enabler from a hardware perspective. But for every dollar of hardware that is put into artificial intelligence activities, we believe that $8 of software will be pulled along with it. And we also think that the companies, the biggest beneficiaries of AI are those companies with domain expertise, especially in the innovation world. They are leading the disruptive innovation. And Tesla would be a poster child of this, one of the biggest AI opportunities out there. So domain expertise with AI expertise. Tesla designed its own AI chip. And then very importantly, proprietary data that no one else has. So Tesla has that in spades. Today, interestingly, one of our other stocks in the flagship portfolio, Teladoc, is up more than 25%, because I believe analysts and investors are beginning to understand how well positioned it is to become the healthcare information backbone of the United States and some other countries because of its AI expertise. So our companies, while they may not be household names, you can count on them that they have domain expertise, AI expertise, and proprietary data.
Finally, Cathie, speaking of prices, do you think we will see a CPI print, a negative CPI print during the next months? Because the PPI is almost there, but what about the CPI?
Yes, the PPI is pointing the way towards lower prices for the CPI. Now, from month to month, it's hard to tell what is going to go on. On a year-over-year basis, we just stepped down from 4% CPI inflation to 3% in the span of 1 month. Now the comparisons aren't as easy as that. But we do believe over the next 6 months, we will see a negative CPI print. And one of the reasons for this is that consumers have said, no more. We're done with these big price increases, and they are on strike. A very good example of that is Conagra. This is a food company. The CEO of Conagra said something happened in April. Before April, the consumer was trading down in terms of quality to avoid price increases. generics, store brands. In April and May, the consumer stopped buying. That to us was very illuminating. It's basically the consumer saying, no, I'm going to pull out of my pantry, what I've stored up, and I'm not going to pay these prices. So that's going on strike against inflation.
Cathie Wood, Chief Investment Officer at ARK Invest, thank you very much for your time. It was a pleasure. I hope you come back the next time also.
My pleasure, Javier. Great to meet you, and I'd love to come back.
Thank you.
Bye-bye.